Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Yvonne Mindrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time, your attention today. And this episode should be going live on April 15th, 2026, which means that today is tax day. And we are either very excited to have that done, we've got our tax returns finished, or we're very apprehensive because we're still working on paying last year's tax bill, or we're still unsure because we are filing that extension and haven't quite filed our tax returns just yet. But regardless of where you stand, it's very likely tax payments are on your mind because today is the deadline to pay the tax due for 2025's tax return. Even if we file that extension, you're still going to have to pay that anticipated tax due. But it's also the deadline for the first quarterly tax payment of 2026. So whether it's for 2025 or now planning for the rest of the year, we're going to be making some tax payments by today. And it's tax payments that I want to talk about today. I want to give you a framework for planning around quarterly estimated tax payments so you're not scrambling or stressed or surprised at tax time, or at least try to reduce that stress, because this isn't the most exciting topic, but it's one of the most common sources of frustrations I see. Optometrists who are surprised by what they owe, or who are caught in a cash crunch situation because they didn't quite have their payments in line ahead of time, or just totally uncertain about how much they should be paying through the year. So let's fix that. Let's have a conversation around tax payments. And the first thing to discuss is, where do our tax payments come from? The USA federal tax system is a pay-as-you-go tax system, meaning you are expected to pay through the year as you earn your income, not all at once in April. And there are two ways to do that. The first way is through payroll withholdings. And so if you have a salary, W-2 income, whether you're an employed optometrist or whether you are the owner of an S corporation, a business that's taxed as an S corp, you're paying yourself a salary, so taxes are withheld automatically from your paychecks. So federal, state if you have it, even Social Security and Medicare taxes. Those are all automatically withheld based on withholding tables. And of course, you can adjust the amounts withheld, but those are one of the levers to use. And what's great about payroll withholdings is that it's considered by the IRS to be withheld evenly throughout the year, even if it all happens in December, which can open up some opportunities later in the year if needed. And I've seen it happen where we need to increase a practice owner's wage by the end of the year, maybe to get them more in line with a reasonable wage for what they're doing, or to increase profit sharing contributions or 401k contributions. And at times, they've also needed to make a big increase to their tax withholding. I've seen them put most or all of that last year's payroll run towards taxes, and that's perfectly legitimate. This is also the case if you're withholding from retirement account withdrawals. So if you are looking forward to the time where you're in retirement, when you withdraw from those accounts, like a traditional IRA, for example, you can withhold from those withdrawals. You can set your withholding percentages. And this can also create some end-of-year tax payment opportunities when you're in a pinch using those retirement accounts. So payroll withholdings, or just withholdings in general, are one way. The second way we make payments are through quarterly estimated tax payments. And these payments are due on the 15th of April, June, September, and January. And we call them quarterly. They don't exactly line up with the quarters of the calendar year. But there are 4 payments due generally on the 15th. And these are payments you make directly to the IRS. There's no payroll involved, and potentially your state, if you have to worry about state taxes, for income that isn't covered by payroll withholding. So things like practice profit above your S corp salary, or all of your income if you're if you're taxed as a sole proprietor or a partnership, or if you had a substantially large capital gain throughout the year, something like that. So it's for those sources of income you'll make those quarterly payments. And which one applies to you, again, depends on how you are working or practicing. If you are an employed associate, you're going to be using payroll withholdings unless you have a substantial odd source of income outside of that. Maybe rental income of net rental profit, I should say, or like a very large capital gain or something like that. If your business is taxed as a sole proprietor or a partnership, there's no payroll for yourself. So you're going to be relying on quarterly estimated payments. Keep in mind in this case, and for you 1099 optometrists out there, you're also setting aside dollars for those self-employment taxes, that 15.3 self-employment tax for Social Security and Medicare. Keep that in mind as well. And if you are the owner of a business that's taxed as an S corporation, we're going to have a combination of both. You're going to have W-2 withholdings, and you're going to have potentially estimated payments on top of that for the profit. And as a reminder, as you file your taxes, what's important is total household payments and withholdings, right? It's your total amount that you've paid in throughout the year across all of the sources of income. So if you have two spouses working, it's both of your paychecks. If you're doing payroll withholdings and estimated tax payments, it's going to look at when you file your return, it's going to show your total tax, and then it will show your total payments through withholdings as well as quarterly payments. And one thing to mention about those quarterly payments is they do need to be on time, right? So there's potentially a late payment penalty if you're making them past those 15th deadlines. However, if you have very uneven income throughout the year, maybe you had a very light early half of the year and you weren't sure that you had to be making estimated payments, again, particularly in early in practice ownership, but then a very strong later in the year, there is a method for your tax professional to use in IRS form 2210 and to annualize your income throughout the year. So basically accounting for the income that actually shows up in each quarter to line up your payments with that income. So talk with your tax pro about potentially using that method if you need to. So we know the two ways that we pay income taxes throughout the year. How much should we pay? This is usually the question that comes up. How much should we be withholding or paying each quarter? And there are two levels of planning here. The first level is, what is our ideal target for the year? And our ideal target is that we're going to get you to as close as a $0 tax due as possible at the end of the year. Meaning when you file your tax return and we look at your total tax after all your tax credits, we want to have you paid in through the year roughly what you're going to owe. There's no massive tax bill or no massive refund. Big refund means that you've dramatically overpaid and you've lent the government essentially your money interest-free throughout the year. Well, that's money that could have been in your own savings account or your own practice or investment or whatever it is. On the other hand, a big tax bill means you've underpaid. Now you could be potentially scrambling for cash and potentially facing penalties and seeing the stress of that. And so for our clients, what we are doing, generally speaking, we're running tax projections throughout the year, coordinating really closely with tax professionals and adjusting withholdings and estimated payments as your income unfolds. So it's a living, breathing process. We can tax plan proactively and try to plan as close as we can to our anticipated tax. Now, the problem is, especially for practice owners, is we don't always know what your total income will be for the year. For a variety of reasons, income can change throughout the year, month to month, and it can look very different from the year before. It could be that your income is simply growing, right? Your practice is growing more quickly than we anticipated, or do you have an unusual large capital gain or something like that, a large source of income in that year, or you may have lower deductions. You may have less expenses, so you may have less depreciation, for example, than you have in the years past. Particularly for you early practice owners. So for those of you who have just purchased a practice or just cold started a practice, there is this time frame in year like 3 to 5 where your income is growing. So your gross income is growing. You're seeing more patients, but also your expenses are tapering down a little bit. All of that early depreciation from either the purchase of the practice and all the assets of the business, like equipment, or from cold starting, all of that depreciation might be starting to taper down. And so your taxable income now is starting to rise and be quite a bit more than it was in previous years. And so if you're not ready for that, if you're not prepared for that, well, that's an example of where the stress and frustration can come from. And so when we're seeing uncertain income, the IRS gives us a few targets to aim for, which they call safe harbors, which leads us to goal number 2, which is avoiding under withholding penalties. And these are targets where if you pay into the system at least a certain amount through the year, you won't have to face under withholding penalties. And there's three of them. There's three safe harbors. And so the number one is that if when you file your tax return, you owe less than $1,000 of tax due, then you don't have to pay an under withholding penalties. Now that's hard to plan for specifically, but it's worth knowing. The second safe harbor is that you've paid at least 90% of the current year's total tax. This kind of requires that you have a reasonable, accurate projection of what you'll owe for the year, which can be a moving target if your income is fluctuating, but 90% of the current year's total tax is another one to consider. The third one is that you've paid at least 100% of last year's total tax. And this is often the easiest to plan around because the number's already known. You can pull up last year's tax return on page 2 of the 1040. Look at the line item that shows you the total tax and then plan around that. Look at the line item that shows you the current tax and then plan around that. Now, one caveat that most ODs are going to see is that if your adjusted gross income, your AGI on the last year's tax return was $150,000 or more if you're married filing jointly, that threshold bumps up to 110%. If you're married filing separately, then it's $75,000. So for most of you, it's going to be 110% of last year's total tax. So which one do you choose? Well, the thing I should say is that you should talk to your tax professional and your financial professionals and figure out which makes the most sense for you. Generally speaking, if your income is expected to be roughly the same or more than last year, meaning like your profit, your income that's going to show up on your tax return, then generally speaking, 110% of last year's total tax is going to be your simplest, most reliable target. This is what a lot of times when your tax professional gives you your tax return and they show you your projected estimated tax payments, those suggested payments are usually based on this approach, right? They're usually looking at last year's total tax, multiplying it by 110% if it needs to be, subtracting out the withholdings, and those are your quarterly payments. So if you're expecting roughly the same or growing net income as last year, taxable income as last year, you might consider using that method. If you know your income is going to be much lower this year, maybe you lost an associate, maybe you reduced your hours, maybe you had an unusual source of income last year, like a large capital gain that's not going to continue on in the future, then 90% of the current year's tax might make more sense. But you're going to want to work with your advisors to project that out. And then as you go through the year, you can update projections. You can look at your actual practice profit. You can look at your actual income from employment throughout the year and make adjustments as you go. We can adjust things as we go. So those are our targets that you can use as a starting point, especially right as you file your tax return in April or earlier in January if you're starting this early. But how do we actually do this in practice? Because knowing your target is number one. The harder part, I think, for most ODs is actually having the cash available when the payment is due. And this is a cash flow problem. And the fix, I think, is relatively simple. Number one, it's calculating your estimated tax payments for the year. This is either you can, if it's accurate, you can look at that suggestion from your tax professional. Maybe they've done the work for you. But if not, what you can do is you can pick which safe harbor target you're going for. So, for example, you can look at last year's total tax. If you need to, take 110% of that, and that's your annual target for the year. Now, you can subtract out your expected withholdings through your payroll. So if you have a pay stub that you're withholding from, you can look at your most recent pay stub, look at how much federal tax is being taken out each pay stub. And as long as you don't expect any major changes throughout the year to your salary, you can multiply that tax amount by however many pay stubs are in the year. So for example, if it's 26, multiply that by 26, and then that's your total withholding amount through pay stubs. And then subtract that from your target amount. And whatever's left over is the amount you need to cover through estimated tax payments. So for example, if last year's total tax was $100,000, 110% of that is $110,000. Let's say you knew you were going to withhold $20,000 of tax in your payroll. So if you subtract out $20,000 from that total, that leaves you with $90,000 of tax to cover through the rest of the year. That's the amount you're going to do for quarterly estimated payments. And then divide that by 4. That's your quarterly amount. Then what you want to do is you want to set up a dedicated tax account. So this is a dedicated savings account. You're either going to open up through the practice or personally in the household. And each quarter, I want you to automate those deposits from your bank account, from your practice, or from your checking account into that tax account. And treat this as an automatic expense that should happen before you are distributing additional dollars to yourself. If we think about our basic sort of cash flow operations, first, we want to make sure we're covering all of our operating expenses in the practice. Of course, we want to make sure we can cover our debt payments in the practice as well. Next, we want to make sure that we are setting aside enough for taxes. And then finally, if we still have enough cash in addition to our planned cash buffer amount in the practice, then we have an idea of what's available to distribute. But we want to tackle this tax payment before we start distributing dollars to yourself out of the practice. And that account is sacred. It doesn't belong to you anymore. It belongs to the IRS or your state tax authority, so that you're not grabbing that money for operating expenses in the business or for spending in the household. If it's done through the practice, what you're going to see, because that's a personal tax payment, it's not a business tax payment like a pass-through entity tax payment would be. Because those usual quarterly payments are personal tax payments, you're going to see that show up as a distribution in your accounting. It's not going to be it shouldn't be a business expense. Now that state's pass-through entity tax payment's different. That is a business expense, but that's not what we're talking about here. And so you can automate that quarterly deposit into that tax account. And if you want to break it down monthly, you can also break that down into a monthly amount and make those deposits monthly. Now, we're already in April, right? So you're not going to be able to break that down monthly for April's payment. And each payment isn't necessarily a 3-month quarter, right? Each one's a little bit different. So the monthly amounts can get a little weird, but you can do it that way if you want. And then through the IRS website, so either through the IRS Direct Pay or through the EFTPS portal you can log into, you can make those payments online, or you can, using that tax account, or even automate and pre-schedule those quarterly payments. And then for state taxes, check with your tax professional and your state tax authority on what they're going to want from you. But the essence here is that you have a separate account just for tax payments, and you automate deposits into that account so that it reduces the risk of forgetting those payments. It reduces the risk of getting behind. You're just automating this whole process. Because the worst scenario is getting really behind by tax time, having made maybe no payments at all, and now you owe a full year's tax bill plus your quarterly estimated payment for the year. That's a really stressful time. And you may have to do like an installment plan, and it can just get really stressful from a cash flow perspective. So the more you can think ahead, the more you can automate this, the more you can figure that out as you go. And then for us, for clients, like we're running those projections, we're keeping in touch with their tax professionals, and we're making adjustments as we go. And as your income unfolds, if you have higher income than you have already expected, then you can simply increase the amount that you set aside into that tax account, and you can choose whether you want to increase your quarterly payments or not. As long as you've hit those safe harbors and you're making those quarterly payments on time, you aren't going to have to worry about under withholding penalties. So it's really just about preparing for the following tax time and making sure you have the total amount of cash necessary to pay those bills. So quick recap, we know how we're making tax payments, whether it's through payroll or whether it's quarterly payments. We have at least minimum targets to shoot for, at least early in the year, where the rest of the year is uncertain. And it's those safe harbors that we talked about. And then we want to automate those deposits into a sacred set-aside tax account that's only there to make those tax payments. And good proactive tax planning, projecting your taxes, adjusting as we go, looking for opportunities to make good tax decisions throughout the year, coordinating between your different professionals. Like that's how you move from being really reactive to feeling in control. And I think what is just super important is proactive communication with your professionals. Let them know when you're making those big investments in the practice, or you're opening up a second location, or buying that real estate property. Let them know when there's changes in your life, when you get married, if you're seeing massive swings in profit or gross revenue. Keep that communication with your professionals so they can update their assumptions and give you good advice throughout the year. And hopefully this conversation is helpful for you as you go through 2026. If you're an optometrist or practice owner, and if you'd like help with more proactive planning in your life, I'd love to chat. You can schedule a no-commitment intro call through the link in the show notes, or you can go to www.optometrywealth.com, and we can talk about where you're at right now and the financial decisions on your mind, and we can share how we help optometrists navigate those same things all over the country. And thanks for listening. If this was helpful, share with a colleague who might need to hear it, and we'd be honored if you can leave a review as well wherever you listen to podcasts. But we'll catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Yvonne's website at optometrywealth.com. Yvonne Mindren is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Yvonne and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.